Imagine this. A CEO gets word before anyone else that their company is about to announce a massive merger. They know the stock price will skyrocket once the news breaks. Instead of keeping that information private, they whisper it to a close friend. That friend rushes to buy shares, and when the news goes public, they cash out with huge profits. Sounds like a slick shortcut to wealth, right? Wrong. That, right there, is insider trading. And here's the catch. People do get caught. When they do, the fallout is massive. Destroyed careers, jail time, and reputations ruined forever. Insider trading may sound like something only the ultra-wealthy or Wall Street elites deal with, but it's a trap that can ensnare anyone. Today, we're exposing exactly what it is and who gets caught. Today on Trust Armor, we're pulling back the curtain on insider trading, what it really is, why it's illegal, and the surprising ways people actually get caught. If you've ever wondered how financial crime works in the real world, this episode is for you. Now here's why this matters. Insider trading isn't just some Wall Street drama played out in big cities and corporate boardrooms. It directly affects the everyday person. It erodes market trust, shakes confidence in retirement accounts, and even puts your personal investments at risk. When a few people play the system unfairly, everyone else pays the price. That's why regulators treat it so seriously. So buckle up, because in the next few minutes, we're breaking down how insider trading works and why it's so dangerous. Let's start with a clear definition. Insider trading happens when someone uses non-public, confidential information to buy or sell stocks for an unfair advantage. Think of it like a rigged game, where insiders know the outcome in advance, so they always win, while everyday investors who are playing fairly lose. That's why it's such a big deal. It's not just about money, it's about fairness and trust in the financial system. Now, not all insider trading is automatically illegal. Here's where the distinction matters. Legal insider trading happens when company executives, board members, or employees buy or sell their own company's stock, but they do it the right way. They report those trades to the Securities and Exchange Commission, SEC, and the information becomes public. That way, everyone in the market knows what's happening, and the playing field stays level. Illegal insider trading, on the other hand, is a different story. This is when someone acts on confidential material information that isn't available to the public, like knowing in advance that a company will announce a major merger, release a breakthrough product, or post disastrous financial results. If they trade based on that secret information, it gives them an unfair head start and undermines the integrity of the market. To put it simply, legal insider trading is transparent and reported. Illegal insider trading is hidden and deceptive. The former is allowed and monitored. The latter is prosecuted and punished. Understanding this difference is key, because while insider trading often makes headlines for its scandals, the truth is, it's the illegal kind that carries serious consequences, not just for the individuals involved, but for the trust and stability of the market itself. Let's bring this closer to reality with some high-profile cases that show just how serious insider trading can get. Take Martha Stewart in 2001. Most people know her as a household name in cooking and lifestyle, but what many forget is her infamous run-in with insider trading. Stewart sold shares of a biotech company, ImClone, after receiving a tip that its new cancer drug wasn't going to be approved. That non-public information allowed her to dodge nearly $45,000 in losses. To an ordinary investor, $45,000 might seem small compared to billion-dollar frauds, but the real damage was to her reputation. Stewart, once America's home and lifestyle icon, ended up serving 5 months in federal prison, plus additional house arrest. Her empire took years to recover. The lesson? Even one tip, one decision can derail an entire career. Now, let's look at Raj Rajaratnam, the billionaire hedge fund manager behind the Galleon Group. He ran one of the largest insider trading networks in history, tapping into executives, consultants, and insiders across multiple companies to profit illegally. In 2011, he was convicted on 14 counts of securities fraud and conspiracy. His punishment? 11 years in prison and over $150 million in fines, one of the stiffest sentences ever for financial crime. The case was groundbreaking because prosecutors used wiretaps, normally reserved for mafia and drug cases, to prove his guilt. The takeaway here is simple. Wealth, power, and connections don't provide immunity. If anything, they make you a bigger target. Regulators and prosecutors love making examples out of big names to send a message. No one is untouchable. When you hear about insider trading scandals, don't just think about Wall Street drama. Think about how quickly one bad decision can flip success into disgrace. Now that we've seen how insider trading has taken down powerful names, let's get practical. What are the red flags you and I should watch out for? Because insider trading doesn't usually announce itself with flashing lights, it hides in everyday conversations and shady opportunities. First, sudden, unexplained surges in stock trades before big announcements. If a company's stock suddenly spikes in activity just before earnings are released, mergers announced, or leadership changes revealed, that's a major clue that someone leaked inside information. Regulators track these spikes like bloodhounds. Second, beware of friends or family urging you to buy quickly without giving a real reason. If the only explanation is a vague "trust me" or "this is a sure thing," that's suspicious. Real investments stand on solid analysis, not secrets whispered in confidence. Third, pressure to keep financial information quiet or just between us. If someone tells you not to repeat what you just heard about a company's future, that's often the point where curiosity should stop and alarms should ring. Fourth, unusual conversations at work hinting at confidential news. Maybe a colleague slips up and mentions a big client deal, or a manager hints about something coming down the pipeline. Acting on that information could land you in serious legal trouble. Here's the rule of thumb. If it feels like you're being invited into a secret money club, run. It's not opportunity, it's liability. The short-term gain isn't worth the lifetime stain of fines, jail, and a ruined reputation. Insider trading thrives on silence and secrecy. Spotting these warning signs early protects not just your portfolio, but your integrity. Now that we've talked about the threat of insider trading and the warning signs to watch out for, let's focus on something empowering: how you can protect yourself. Remember, prevention is always better than damage control. And a few simple steps can keep you safe, both legally and financially. Step 1. Stick to public information. Only. When you're making trades, base your decisions on information that's available to everyone. Company earnings reports, press releases, industry trends, or financial news channels are fair game. If you can Google it, read it in a report, or find it in a public filing, you're in the clear. Step 2. Avoid hot tips, unless verified. If someone says, "I heard this from a friend at the company," or "buy this stock before tomorrow, it's about to explode," that's a massive red flag. Unless the tip has already been published in legitimate financial media or official filings, don't act on it. When in doubt, step away. Step 3. Follow compliance rules strictly. If you work in finance, corporate leadership, or any role with access to sensitive data, you already know how tight compliance rules can be. They're there for a reason, both to protect the company and to protect you. Always disclose trades if your employer requires it, and never share information casually, even with friends or family. Step 4. Keep digital records of your trades. Maintaining records of your trades shows transparency and protects you in case anyone ever questions your activities. Screenshots, brokerage statements, and even simple notes on why you made a trade can serve as proof that your decisions were based on public information. By sticking to these protective steps, you not only shield yourself from the devastating consequences of insider trading, you also trade with integrity, which in the long run builds trust and success. So let's say you find yourself in a situation where things don't feel right. Maybe someone gave you a stock tip that sounds a little too good to be true. Or you realize after making a trade that the information you acted on wasn't public. What do? Here's a clear action plan to protect yourself. First, stop trading immediately. Don't try to make more money or cover up what's already been done. The longer you keep trading on questionable information, the deeper you dig the hole. Second, document everything. Write down dates, times, emails, conversations, or text messages related to the situation. This isn't just for memory. It's evidence that could help show whether you knowingly engaged in insider trading or if you were simply caught in a bad situation. Third, seek professional help. If you work in finance, corporate roles, or industries where compliance is strict, talk to your compliance officer right away. If you're an independent trader, don't hesitate to contact a lawyer who understands securities law. Getting expert advice early can save you from mistakes that make things worse. Fourth, report to the proper authorities if necessary. In the US, that might be the SEC. In Nigeria, it could be the EFCC. Many regulators even allow anonymous reporting to protect you. Here's the golden rule: the cover-up is often worse than the crime. Transparency is your best defense. Trying to hide what happened, deleting emails, lying about trades, or ignoring compliance policies only escalates the problem. Taking these steps doesn't just protect your finances, it protects your freedom and your reputation. Because in the world of finance, one wrong move can undo years of hard work. As we wrap up, let's quickly recap what we've covered. Insider trading is the illegal use of non-public information to buy or sell stocks. It may seem like a shortcut to quick profit, but history has shown otherwise. From corporate executives to everyday employees, many have been caught and punished, sometimes with heavy fines, prison time, or lifelong career damage. We also highlighted the warning signs to watch: sudden stock surges, pressure from friends or colleagues to act fast, or being told to keep information secret. If you notice these, it's a red flag. On the positive side, protecting yourself is simple. Trade only on public information, avoid unverified hot tips, and document your trades. And if you ever suspect involvement, stop, document, seek legal help, and report it. Remember this anchor truth: insider trading may look like easy money, but it always costs more than it pays. As we come to the end of this video, I want to leave you with this encouragement. Remember, you are not powerless in a financial world full of risks. The market may seem overwhelming at times, but knowledge gives you control. By learning to recognize the warning signs of insider trading, and by sticking to the rules, you protect not only yourself, but also help keep the playing field fair for everyone. Everyday investors like you have a critical role in shaping a trustworthy financial system. When you make smart, informed choices, you stay one step ahead and you build confidence in your journey. Stay alert, stay wise, and always remember, your decisions today determine your financial strength tomorrow. If you found today's video helpful, don't keep it to yourself. Subscribe to Trust Armor, hit the notification bell so you never miss an update, and share this video with a friend who invests. You never know, the information you share could save them from a costly mistake. And I'd love to hear from you. What's one financial red flag you've spotted before? Maybe it was a too good to be true investment pitch, or a trade that just didn't feel right. Drop your experience in the comments. Your story might be the very thing that protects someone else in our community. Remember, staying informed is your greatest protection. So let's keep learning, growing, and protecting our financial futures together.